This post was on January 30th. KGS way down and after hours, gonna hurt. And I like what John said. It's down a couple of points pre-market. Luckily, not an SGMO. SGMO, we got absolutely creamed on a while back. And it sucks, to put it mildly. It comes with the territory. It happens, or shit happens. Might as well demonetize, get that out the way right now. Now, my answer was, I hear you, but if you focus too much on the zigs and zags, you put yourself to many states of regret, which we'll get into in just 1 second. Discipline gets worn down. Amen. And I read that from a book by Scott Adams, and I've seen it elsewhere since. But it's like you have plenty of discipline, but then it wears out as the day wears on. Or let's say you're dieting and you do really, really well for a whole week, and then all of a sudden just the shit hits a fan and it blows up. That's very typical, and that has to deal with the discipline cycle and emotions getting used up, and a discipline more specifically getting used up. And as you likely know, a negative observation is twice the impact of a positive one. We'll get to that too. So negative observations could eat away at your discipline, and it does. You have to go in saying, this is my risk, I can handle it, and if I get stopped out, I might drop an F-bomb, but I'll be just fine. So the point I was making with this, and so far it really hasn't worked out to my liking, obviously, for this presentation, but let's just see what happens and let the chips fall where they may. So he was right. It did get whacked in after hours. Not a tremendous spanking. I've seen much worse, believe me, not that long ago. The thing I was thinking about, though, is if this stock does rally above that new closing high where it was, if it goes on to make a new closing high, then you wasted some mental energy. And as I used to say quite a bit, especially when I lived out in the country, I would look at my position trades, mostly from like the core trading service, and they would all be down on a day, or most would be down on a day, and I'd get pissed off and drop some MEP funds and such, and then walk around the block. And in the country, the block we lived on was about nearly 2 miles around. And by the time I get back all hot and sweaty and aggravated, not every time, but many, many times, the stocks all came back, and they were actually in plus, and sometimes quite nicely. So it made me realize that I was wasting a lot of energy watching every zig and zag. Now, I looked it up, and there's a little bit about this in fact, they actually reference this, I think, Thinking Fast and Slow by Kinnerman, and it's not Thaler, but Thaler's done some really good writing on this too. He's pretty good when it comes to this behavioral psychology stuff. But there's a word for it, and actually neurologists have proven this too. It's not just a psychology, but there's a neurology behind it. And it's called negative potency. The principle of negative potency, easy for me to say, asserts that given inverse negative and positive events of equal objective magnitude, market goes down 1 point, the market comes back 1 point, okay? The negative event is subjectively more potent and of higher salience than its positive counterpart. More generally, the claim is that the negative events are more potent with respect to their objective magnitude than or positive events. And I've often say it's 2 to 1. I think Craig, who's usually here on Thursday, one of my clients, been a client forever, I think he said it's more like 10 to 1 or whatever. So I'm not sure exactly what it is, but it's a lot. And that's what creates the gambler's ruin, okay? So you make a little money gambling, it feels good, and then you lose some, and it feels really, 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 really bad. And like I told my wife once, years ago, I had like a dinghy from a boat that I'd sold, and we sold the dinghy, and I said, hey, let's take $1,000, or no, it was only $200. Let's take $200 from the sale, and let's go parlay it into $1,000 or so. And she's like, all right, she was game. And so we went to the casino, and believe it or not, we turned into about $1,000 or so shooting craps, maybe $1,400. But anyway, somewhere around that. It was a really good, decent little amount of money, a lot of fun out, free drinks and whole 9 yards, nice dinner. And then on the way home the next day, I said, this is probably the most expensive trip we've made to the casino. She's never been to the casinos over on the coast, Mississippi coast. She's like, why? I said, well, because we were one, and you're going to want to go back. And then I didn't get into all the gambler's ruin or whatever, but that is a big part of it. And you end up chasing that high. And trading is no different. You got to be really, really careful. Now, this is an example that I found that was part of the resolutions that I did. And I'll show you this one in just 1 second again. And I thought this was kind of a cool example to show because it rallied up and hit the initial profit target. That's this little green line in here. And by the way, anytime you see these little snippets from trades in here, these come, I use it myself. I go directly to davelandry.com/archives, and I pull these older trades out of there, so I could see, okay, where was my entry, where was the stop, where was the initial profit target, and so on and so forth. So I don't have the labels in here, but this was the entry, this was a stop, this was the initial profit target, and this was the risk, and the pattern was an IPO first pullback. So I thought it'd be interesting to map out the ups and downs. And so let's let the up be 1 and the down be -2. Now, what I didn't do was I didn't exactly map out the magnitude of the moves. And that's what they were saying earlier. It has to be of equal magnitude. But if that number is bigger than -2, like we said earlier, I think Craig was saying, then this really doesn't matter. But for illustrative purposes, this kind of gives you the idea. So I mapped them all out and spreadsheeted it. And on the up days, I gave a +1, and on the down days, I gave a -2. So that was that little range we just saw. Now, this stock went up and hit the initial profit target. Okay, remember, once we get to the initial profit target, we move the stop to break even. So had it stopped out on the remainder, overall, it'd have been a decent trade, 1% overall, and the hypothetical 100K account, so that'd be $1,000. Okay, and I actually do take the trades, so that'd have been a real, for me, it was a real $1,000 in this particular case. But anyway, you could see that that one little section of trading, because it just kind of went sideways and zigged and zagged, actually created a lot of this negative feelings. In fact, if you plot out a lot of these things in trading, overall it's a net negative, and that's something that's really hard to manage unless you really want to manage it. Very important to deal with. Now, keep in mind that this was a profitable trade. It was about to get more profitable. Now, the reason I say about to get more profitable is because it took off from this low. Now, I don't want to pull my clients. I don't want to upset them. But I'd be willing to bet a lot of people gave up during this zig and zag. And I could probably go back and look at my emails from this period of time. And I'd be willing to bet that people say, well, Dave, it's dead money. It looks like it's going back to where we started. Might as well get out. But then it had a pretty good run since, and that turned into a big winner. This is a multi-year winner, starting in 1 year and going into the next, starting in 2023 and then finishing up in the middle of 2024. By the way, that's the ultimate goal, to get into these trades and hold them for as long as possible. And I'll come back to that one in just 1 second. Now, how do you live with the ups and downs? Well, you have to accept the outcome going into the trade. And we're going to get into this when we get into resolutions. But you have to be willing to accept the outcome, good, bad, and indifferent. Now, you have to say it's worth the risk. If I don't take this F yeah, and by the way, when you're looking at a trade, you should feel like F yeah. You should have that gut feeling like, hey, I'd be stupid not to take this trade. So if I don't take this F yeah trade, I'd be angry, and I'd be angry if it took off without me, okay? So that fear of missing out is so painful, and I call it the pain of missing out, okay, POMO, because there's been a few that I should have taken throughout my career, and I think about them every now and then. As I've said before, I'll ride by the marina, whatever, my bike, and I was like, oh man, you know, that trade that I didn't take, you know, that TLRY, it went up to 1,000, and it was a perfect setup. I don't know why I didn't take it. It's like it just doesn't go away. So that's a very painful part of trading. I'm kind of sidetracked on that. But if you go into it and say, this is an FEX setup, and I know my risk, and I think it's worth it, if I get stopped out, so be it. There'll be other ones along the lines. Now, conversely, you might think, I don't think it's worth putting money into harm's way. I don't care if it takes off without me. Now, I do understand this gentleman that posted that earlier. He's in a situation where he's outside of the States, and I'm guessing his wife works there. Otherwise, I'm not sure why he'd be living there. And he's not allowed by law to work. So I think that creates the extraneous influence. I think the extraneous influence is huge on him, and it's very hard to take these losses. So, you know, I'm just kind of, what's the word? Embellishing, right? You know, his wife comes home and I worked hard today, made some money. What'd you do? Oh, well, we lost money overnight, you know, and I'm just guessing that's how he must feel, because I know I feel that way quite often. Anyway, I was looking for some quotes from Douglas. There was specific quotes about if you if there's any animosity after you take the trade, then obviously you haven't accepted the risk. And I couldn't find it in the books, but I think that was in one. John Ross, you had to bring up TLRY again, didn't you? Yeah, I know. It kills me. It kills me. I would have bought at least, and I'm thinking just in one account, I'd have bought at least 1,000 shares. And it's just and I'd have taken some profits along the way and shoulda, coulda, woulda. But, what would the world be without hypothetical questions, said Mr. Wright. But it's like, damn, and that's what we live for. Why? I don't know. I have no idea. And if it wasn't so damn painful, I would go in and watch a service on that day. And I don't know what I said, and I probably need to go back and look at that. But anyway, I found this from Douglas, which was pretty good, which was trading in the zone. I like the disciplined trader better just because it was the first one, I guess, and I was struggling a lot more when I read that. But trading in the zone is worth reading, and anything by Douglas is really good. And the fully acceptance of risks came from some YouTubes on, and there's a lot of really good YouTubes out there. Mr. Douglas is no longer with us, unfortunately. As I said before, I only met him briefly, so to speak, on the phone, and we were supposed to be put together on a project from a third party, and it never did materialize. And that's really a bummer because I wish I'd have gotten to know him anyway because he seemed like a nice guy. Anyway, there's a huge psychological gap between assuming you are a risk taker because you put on trades and fully accepting the risk inherent in each trade. When you fully accept the risk, it will have profound implications on your bottom line performance. So you have to decide, okay, is this an F-yeah trade? Is it worth it or not?